Dividends vary based on how much base premium you have, how much paid up additions you have, what health rating class that you're in and how that's functioning within their general fund account. So what the mortality rates have been for your particular class, that can affect it as well. So the insurance company in general just declares, this is how much dividends we're paying out. This is what that looks like as a percentage, but the way it gets applied to each policy may be a little different. So we always want to consider the dividend rates as like a general number. Okay. It's a gross number for sure. It doesn't include expenses will come out above and beyond that. Okay. But it'll get treated differently on each different account. And we know this because we get hints in places like we can see, if we just look at the raw numbers, we can see like, oh, that's not 5.65% of my cash value. Why isn't that? Well, there's expenses inside of it. Remember, we've talked earlier this year about general fund accounts in insurance companies doing a lot better because the interest rate environment has gone up. Bond rates have gone up. That allows the overall general funds to do better. Now we got the first indication of this from Allianz, and we could really see it in other IULs as well when we see fixed interest rates going up, fixed interest rate accounts going up, cap rates going up, participation rates going up. Those are clear indications that general funds are doing better from an insurance company. Okay. And general funds for insurance companies are built on long-term bonds. Okay. They buy bonds and they hold them for the entire period. They don't trade them. Our volatility indexes that our IULs get tied to, those do a lot of trading of bonds. So that's why our volatility indexes didn't do so well this year. And people say the bonds went down along with equities, right? Well, the value of bonds did go down along with equities. They both got hit hard this year, but bond rates actually went up. It's the people trading bonds that got the hit. The value of the bonds that they had already bought went down because bond rates went up. So for insurance companies, it's been a really, really good year. The expectation from me was that dividend rates will slowly start to turn around. It's like a big ship. You've got these massive portfolios, these massive general fund accounts that are going to slowly start to turn up. They come down slowly and they go up slowly. Okay. So it's not like bond rates and stuff are going up immediately. They're going to start issuing higher dividends. Okay. They take their time, just like they don't want your account going up and down year after year. Okay. That looks like an unsustainable business practice. It makes people nervous to not know what anything's going to be by large numbers year to year. So insurance companies like to go down slowly and up slowly as things turn around. Insurance companies love to declare largest dividend, but like they're continuing to get new clients. So it's not necessarily a much bigger percent wise that each client is going to get. It's just a larger dollar amount, but it gets spread out over more people. So that's why Northwestern's $6 billion dividend is a lower percentage that goes out to their clients because they have a lot more clients. When I talked about the dividends being applied differently, here was one of the little nuggets I came across. So Sun Life, Clarica, they've got pretty good dividend numbers here, but these are like stock companies. So like one of these is Prudential, so that these guys run Mutual Life, MetLife, Clarica, Allstate, and Prudential. All those are ran under this Clarica brand, it looks like. But check this out. Reducing dividends for pro-smoker policies. This is a result of the mortality and adverse mortality review for these policies. So what they noticed is across their book of business, for people with smoking rates, they're seeing a higher mortality rate. And so they have to adjust how the dividend pays out for that particular group of business. So that's one of the reasons why you don't see the same amount applied. That 5.65 or 5.75 dividend declared rate, you're not necessarily going to see that because they may be treating your class a little bit differently. Whatever you qualified for a health rating, might be treated a little bit differently based on how people are actually dying. We don't know what goes into a lot of those decisions because they don't have to declare it. They don't have to say this stuff, right? This is probably something that comes out every once in a while from a single carrier, and it just kind of gives us a little bit of insight into what's going on inside these companies. Those are all generally considered proprietary information, how they allocate their dividends, what they charge for each asset class, things like that. Those are all proprietary stuff. They won't release it unless they're forced to by the government. So there's a lot of trust you put in that whole life that it's doing what we expect it to do. Like you're getting treated fairly with how that dividend is getting allocated to your particular policy. At the base level, we have the guarantees, which is nice. We know it's always going to go up. We just don't know how it's going to go up above and beyond those guarantees based on the dividends and how those will get allocated to your particular policy. It doesn't matter if they're declaring a 8% dividend if you only see a 4% growth. And it's like, that's interesting. Why did that happen? Well, the declared dividend rate is just the general declared rate. That particular policy obviously didn't get credited with that full rate on all of the dollars that are inside the policy. So keeping in mind that the dividend rates are gross numbers, you're not going to see that exact number on your returns in your annual statements because the expenses are going to need to come out, and the dividends can be credited differently based on base premium, PUA, and your health rating and how the mortality expenses are affecting your particular class. Let's take a look at some top carriers' historical dividend rates. So here you can see we've got Guardian, Mass Mutual, Penn Mutual, New York Life, and Northwestern. And here we've got the average since 2002. I'll scroll down here and see these numbers since 2002. I've just ran the calculations so that we can get the average here since 2002. You know, oftentimes when we're looking at which carrier to use, dividends are not the number one factor. We want to make sure we're using a carrier that has paid dividends out. And, you know, Guardian, Mass Mutual, Penn Mutual, all have paid above the guaranteed amount for 150 plus years. So we like to see that. New York Life, Northwestern, probably the same for them too. But we do like to see that. It is not the case with all of your whole life carriers. And these are also major mutual companies. So you become part owner of the company. There's no shareholders to have a conflict of interest when it comes to the paying out of the profits. So I hope you found value in that. Thanks for joining us today. Be sure to hit that like button and subscribe if you're finding value and you want to follow along as we release more videos sharing insights on the insurance industry and how to maximize your cash flow.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.